If everyone calms down, stocks and crypto are going to do great. But with that being said, most of the time, the world is actually good.
What's going to happen if one day, if things are not going back to normal? Once this escalates, there's not that much you will be trading. It's more like you have to be kind of protecting yourself.
Listen, ironically, I actually think that's a bull scenario for stocks. 5 years ago, we would have threw a party. Whoever has the cojones to stick in there is going to make a lot of money.
Leveraging a unique passion for global financial history, mathematics, and computational research, Spencer is quickly becoming a prominent figure on Wall Street.
His intuitive grasp of market dynamics and disciplined risk management have been highlighted by Bloomberg, Reuters, and other major financial news outlets.
If we assume that this doesn't escalate, is the world fine actually right now?
I might be giving a somewhat bearish view on macro in 2025, but
Hey guys, so I'm back with another episode, this time with a very interesting guest, actually from the US. And his name is Spencer Hakimian, and I think you work for Tulu Capital. Maybe you can quickly introduce yourself.
yeah, thank you for having me on the podcast. I'm excited. So my name is Spencer Hakimian. I work with Tulu Capital Management. We're a macro hedge fund based out of New York with a roughly 70 million US dollars under management. And the core tenet, our philosophy is to invest opportunistically across uncorrelated asset classes in order to earn a risk-adjusted return that is superior to the market. And I don't want to spoil too much. I know we're going to get into it in the podcast, but that's the crux of who I am and what we do. And we've been operating for 5 years now. And yeah, I look forward to any questions or commentary on the market.
Cool, yeah, that's great. Yeah, I've been following you for quite some time on X, and I just always thought you had some interesting takes, on the macro side of things. So that's why I wanted to bring you on. But maybe first, I actually wanted to start, or I wanted to talk about, the situation that's kind of unraveling at the moment, because I was preparing for this interview earlier today, and then I had this question about Iran, Israel, potentially like being a hot stone or something, in the Middle East. And then when I was driving home in by train, I was just opening up social media and I actually saw that Iran just sent these missiles towards Israel, and I find it it's somehow tragic, but at the same time, just really interesting to see, but I mean tragic in the sense of like you have these people, and they're probably now pretty harshly affected over there. And then at the same time, you have me, sitting here in Switzerland where I'm at, and then I'm following and observing this. And then you have people on X, posting about their bags and what's going to happen maybe to their portfolio. And it's just this weird mix of everything, this world that we find ourselves in. And I would be curious how you see all of this.
Yeah, for sure. So, I mean, first of all, we wish nothing but safety for the Israeli people, also for the Iranian people, for the Jordanian people, anyone affected by this. We sometimes forget in the United States, these are all innocent people, to varying degrees. I mean, this is, really just government on government disputes. So that's first and foremost. And then as it relates to the markets, obviously, the biggest thing regarding any type of conflict when it happens in the Middle East is oil production, and specifically a reduction in oil production, either via embargo or via damaged refineries in like a missile strike or something of that nature. So in terms of what, we're looking only from an investment perspective, most closely is going to be anything regarding oil and natural gas. And, oil futures in the US or Brent in Europe were up 5% within about 20 to 30 minutes of the attack. I know you mentioned my X before, my Twitter page before. And a few days ago, when Israel assassinated the former leader of Hezbollah in Lebanon, I wrote on Twitter, I think oil's a little bit too low. I mean, this is the crown jewel in the Iranian defense, and Israel just obliterated it. I mean, how could Iran not respond back to such a thing? And if Iran responds back, Israel is a nuclear power. They're not just going to let missiles land in their capital, Jerusalem, or in their main cities of Tel Aviv, Haifa, etc. They're going to respond back. And it's just, a classic type of war play where oil shoots up. And I know we have a permanent position in commodities, not a big position because it's pretty volatile, but we do have a permanent long position to an extent. And so actually it's October 1st, on a day like today, the market's down. We're actually up about 15 basis points for the day. So, I mean, we're doing decent for ourselves. And this just does relate to us. But in terms of long term, just like what you kind of saw after October 7th, unless this exponentiates, which it definitely might, the reaction could be very muted. Neither Israel nor Iran is significant enough to global GDP, really outside of Iran's oil production, for this to matter for markets in the long term. And obviously, there's a big human effect to this stuff. I don't want to discount any of that, but in terms of as it relates to asset markets, unless something happens significant, if there's a bigger escalation, which is very possible, but unless that happens, oil probably is going to return back within, a day or two to previous levels. And if it doesn't, that's when you can have your big problem on your hand. So if you recall back in March of 2022, it looked just for a brief moment like the Ukrainians and the Russians may have been able to have worked out some type of resolution, maybe that first week of March. And asset markets went back to all-time highs in March, if you remember, of 2022. Risk assets stayed great. And then towards the end of March, it started to look more obvious that, no, this is going to go on for quite a while. And that's when, risk assets started to really fall all the way through December of 2022. And oil went up essentially in a straight line until September or October of 2022 of that year. So the biggest thing we're looking for is, if this escalates and if oil prices were to rise, generally speaking, bond yields should rise too. If oil prices are rising, because that's inflationary, and if bond yields rise, stock prices generally should fall because risk-free assets are higher. So that's kind of how we're looking at it. And if it doesn't, then this could just be like October 7th, where in terms of the market's impact, we're not really thinking about it in terms of investments within,
Yeah, that's interesting. I mean, that's always what I'm asking myself. That's what I meant when I opened up Twitter today, or X. Like, you have these people, they're like, especially the crypto folks, they're like, okay, they're posting memes and they're like, okay, World War III is around the corner, and yet again, I'm just going to bid, because it's max fear, and then it's just going to be going back to normal after a few days, and probably it will, because nobody wishes for like true escalation, but I'm just wondering, like, what's going to happen if one day, if things are not going back to normal and something like this could actually escalate, and then we could be actually looking at World War III or something like this, and I'm just wondering, how do you go about trading something like this, or how do you go about like preparing for something like this? Because I think once this escalates, there's not that much you will be trading. It's more like you have to be kind of protecting yourself.
So first of all, let me say, Israel is a nuclear power, and it's highly speculated they are. They've never admitted it, but it's speculated they are. And a nuclear power has never in history been attacked on its own soil by a sovereign. So the United States was attacked by a non-sovereign, Al Qaeda, but that wasn't a sovereign state. This is possibly the first attack in human history that a sovereign state attacked the territory of a other sovereign nuclear state. So obviously the odds of war are very high here. With all of that being said, we have to stay invested. Um, Obviously, how we would invest would change rapidly, but we are not going to go to cash. We would switch to other assets, and we are already sort of permanently positioned for events like this. That's how, we're up on a day like this. We weren't trading so heavily in the morning. We were up because of how we were positioned. And if it gets worse, we would have to position ourselves more for the probability of this getting worse, right? So we're never 100% just long risk. We're never 100% short risk. We're because you don't get paid enough to be like that. We're trying to assemble a portfolio that does well irregardless of what's happening. And then when major things happen, maybe we tweak it around the edges to capitalize and make a little bit more money based around what may happen here. But I mean, look, if everyone calms down, which hopefully they do, stocks and crypto are going to do great, right? And if everyone doesn't calm down, gold, short bonds, and oil and the dollar are going to do great. Maybe the Swiss franc does great also. Because it's a safe haven currency. So again, and I'm only talking, I know this is a sensitive topic, I'm only talking about this from an investment perspective. We don't really care what happens because we can make money in almost any type of environment to a reasonable extent. I mean, we can get completely caught off guard by something, and then we will be down a little bit, but the whole reason our fund exists is sadly for moments like this, and it should do well. So we don't really fear it from an investment perspective, and we'll trade it as the news develops, and not a second earlier, not a second later.
Yeah, makes a lot of sense. And yeah, as you said, it's just from an asset point of view where we're looking at this. And then obviously, as an investor, you cannot trade as if the world is going down, like into shitters. And also, like if you were, like a Samaritan, who's you have to kind of position yourself just the way reality could unravel. And that's why you have to kind of think through all possibilities and eventualities.
I'm always just writing on my social media, on Twitter, on LinkedIn, that asset markets aren't a philosophy class. They're not, about what's right and wrong. This is just, this is a probability mechanism. And that's all it is. I mean, it doesn't make someone a bad person to, be long oil because that's what's going to go up right now. That's just what it is. I mean, it's not like, it doesn't make you like corroborative in what's going on right now. It's just, it is what it is. And it wouldn't be intelligent to be long stocks if there's going to be a regional conflict and the price of oil is going to go up $50 a barrel, right? It's just, it's neither good nor bad. It is what it is. And, but with that being said, most of the time the world is actually good, right? Most of the time, we're not waking up to news of people lobbing missiles at each other. Contrary to what sometimes you're going to read on Twitter, most of the time things are better. They end up literally coming out better than expected. And that's why
exactly.
Otherwise, we'd be a long short book. We'd be a long short book. We're not. We're a long only macro fund. We think that we can hedge the risks, which are very clear, but they're not as common as the upsides, with other longs. We don't think we have to be permanently short 30% of our exposure for that once in every 7 years that you get a negative 30% year. We just don't think that makes any mathematical sense. And I think our data and our back testing and our track record, we're young, we're small, we only have 70 million, but I think it proves it.
Yeah, exactly. Well said. Yeah, that's very interesting. I think you said this. I think that's as you said, well said. Like most of the time the world is just fine. So the question I have now, if we assume that this doesn't escalate, is the world fine actually right now? So how do you see the macro picture? That's maybe something I'd like to get into.
So I mean, I'm going to talk about the United States at this point. We focus on the United States. I mean, I could talk about Europe, Asia, Latin America, anywhere, but I'll focus on the U.S. for this point in time. But just one more thing, I want to just drill on. I don't want to sound like a broken record, but beyond that, it's just a probability mechanism. Financial markets. It also matters what is priced in to happen, right? As an example, 10 rate cuts are priced in right now. Okay, we got our first 2 rate cuts in the United States last week. Bond yields are up since then, because what you have to understand is if something is right, if everyone tomorrow morning knew that thing X is going to go up 10% next year, well, they're going to buy it up right now. They're not going to wait for that thing to go up 10%. So I think the most important thing that sometimes people, especially on social media, might not understand is if something is already priced in, you might not make money just because it happens. Something beyond that has to happen. That's already in the price. Like markets are very efficient. So as an example, I might be in the next moment or two giving a somewhat bearish view on macro in 2025, but relative to what is being discounted, that still might mean you should position your investments somewhat aggressively. I know that may be a little bit hard. I'm sure you understand it, but I'd like for someone not in this industry, that may be a little bit hard to conceptualize. I'm not really aware of any other industry where, the consensus might be bad, and if it just comes in a little bit less bad than what was expected, that might be a great year for you. And then let me get to the macro picture a little bit. Enough with my philosophy. I've ranted enough. So in the US, I think we have a little bit of a slowdown. Nothing severe. Nothing, in my opinion, that warrants 10 rate cuts. It's a little bit of a slowdown, and my personal best guess was that bond yields reached 5% in April and May of 2024, and that really damped some activity temporarily in July and August, and you kind of started seeing some soft stuff. But now bond yields are back to 3.6, 3.7, 3.8, or in that range, and we've already seen activity pick up pretty decently, I want to say. And then the biggest thing that I think we have to think about in terms of macro is we've never before in history permanently done an 8 or 9% deficit relative to GDP. I'm talking about the US right here. Just conceptualize what that means. For nominal GDP to fall, and government is about 30 to 40% of the economy between the federal and the state level, and the multiplier effect of that spending. I mean, just think about what has to happen to the rest of the economy to offset that much deficit spending that's happening. Again, I'm not saying it's bad. I'm just saying, put it on a bar napkin and just do the simple math. It's not easy. If 40% of a company's customers are increasing their spending by 25% in a year, the other 60% have to be doing so bad to get that company's revenue negative year over year. It's a little bit hard for it to happen. And is it fair? Is it unfair? I don't know. You guys, let the politicians decide. Not that they will decide anything, but let them talk about it. I'm just here to make money off of what I'm seeing. And so that's that. And so my big thing is that I just do not see the economy softening enough to warrant what needs to happen in the bond market to get 10 cuts in 8 meetings or 7 meetings or so with that being said, I'm not the biggest fan of long bonds here. I wouldn't be stunned if mortgage yields have sort of plateaued right in this average of 6.25-ish, which means if you're a good borrower, you're getting it in the low to mid fives, and if you're a great borrower, you might even be seeing the four handle. And yeah, I mean, so that's just something that I see, and also with all this fiscal, I see this flowing through into stocks, and I personally just see stocks having a decent year in 25. I'm not really short anything, but I wouldn't really be buying long bonds here or short bonds, honestly. And I see gold and Bitcoin doing really well, both for debasement, for currency debasement, for deficits, for everything that I've been stating, but at different times. Gold's a risk-off version of that play. Bitcoin's a risk-on version of that play. So they're both worth having because they're uncorrelated, if you ask me. And that's the ultimate way to smooth out your volatility. But that's sort of how I'm thinking about it. And just also, no matter what happens in our election in a month, one way or another, I don't think either Trump or Kamala Harris is going to have a cooperative Congress, because I think the Democrats are going to win the House and the Republicans are going to win the Senate. So it kind of really doesn't so much matter who the president is. I mean, don't write that one on Twitter, right? They think the world's going to change a lot on that day. But so because of that, I don't think any of them really can implement any of their things, and it's going to kind of just be status quo. And status quo is working pretty well, at least for equity. It's not working for our national debt or anything, but it's working for equities. So I'm kind of bullish, and I think a lot of the election uncertainty is going to calm down in a month from now when they realize, oh, okay, we just switched one or two characters. Not much is going to really happen out of this. So yeah, that's where I'm kind of.
Yeah, very interesting. A lot to unpack here. Thanks for making it all clear. Well, I mean, one thing that I would like to talk to you is the thing that you mentioned about the rate cuts, like these 10 rate cuts that have been priced in. And obviously, you're exactly right. Markets are like forward looking and they're pricing things in. So that's where I think there might be a little bit of a surprise, or that could kind of catch markets also and market participants off guard, because what if, for example, because I think that's what the Fed kind of is focusing on right now, the labor market, they kind of stated this as well. They kind of switched their focus from inflation now to the labor market because it was sort of deteriorating. But what if this market were to reaccelerate again, or maybe as we have been seeing, like US jobless claims and stuff, they're always lower than expected. So could that be a risk where it's all of a sudden, like the central bank will have to say, okay, the market has been way ahead with the rate cuts and we're not going to follow through. And that is exactly what you kind of explained. It's not super bad, but it's also maybe a little less good than generally expected. And this could kind of then bring expectations down and also trickle down into market prices. You see that risk at all?
I listen, ironically, I actually think that that's a bull scenario for stocks. That means that the economy in the future, when we look back, was doing well enough that it didn't need 10 rate cuts. By the way, that was kind of the entire story of 2023 and 2024. Rate cuts. We've gotten 50 bips so far, right? We've been talking about rate cuts for 18 months now. We've gotten 2. And I mean, go look at what the Nasdaq's done in the last 18 months. It's up 100%. So, I think that is one of the bull cases for the equity market. I think the bear case for the equity market is if we actually get 10 rate cuts. I think that's like, oh my God, something actually happened, right? And that means, oh my God, 10% fiscal didn't offset anything. Something's really going on. With that being said, though, that's a 6-month trajectory, and that's how I think. I think it's how you think as well. We're going to have a payrolls report in the United States in a few days. I think that's coming in somewhere in the mid 100s, something similar to the past couple of months. Not great, not awful, but just like room temperature. But the following jobs report, which is going to come out November 1st, which is 4 days before the United States election, we're going to have Hurricane Helene, and we're going to have this dock worker strike potentially in the US in that. That is probably enough to push the payrolls negative for the month of October, which comes out on November 1st. The Fed only cares about the job market right now. They shouldn't, but it doesn't matter what I think. It matters I'm not on the Federal Reserve Board. I have to trade based on how they think. It doesn't really matter what I think. I wouldn't be so shocked if they do 50 again, because we may get a negative print. Listen, for temporary reasons, for a hurricane and for a labor strike. These things are going to go away within a month, 6 weeks, however long it takes. But they're going to look at that. I think they might do 50. And if they do 50, you can just go ahead, because I don't think the economy is going to be doing bad, but it's going to look like the labor market is doing bad, and the Fed is going to be easing. Just like what they did at the meeting a few weeks ago. Bond yields are up, stocks are up. So bond yields are up, meaning bond prices are down. Stocks are up, gold is up, Bitcoin is up, the dollar is down, right? So if anything, that 50 basis point cut did probably the opposite of what you'd want it to do. You've raised bond yields, you've raised borrowing costs in the economy. At the same time, you've loosened financial conditions, right? Any corporation right now can go issue some stock if it wants to, or go borrow at basically the Fed funds. So you've done all of this. They might do it again. And look, I just think we might be in a scenario where, like, the first half of 2024, we just repeat it once more in 2025. We got too loose, too quick. The economy wasn't falling off. They're not understanding, or they don't want to understand, that when you're putting in this much fiscal stimulus into the economy, this is quasi-rate cuts, right? I know it's not fair, but it is what it is. The United States Treasury is quasi-putting in stimulus at all times into the economy. Maybe we need a higher neutral rate, maybe 3%. Maybe that's too high of a neutral rate. We'll see. Look, the GDP is going to come out in a few days, in 3 weeks. I think Q3 GDP grew at 3%. What more do you want than that? It's like real GDP is growing at 3%. Like 5 years ago, we would have threw a party if we did that. We get every quarter now, and we're acting like the world's ending. It's baffling to me, and that's where I think gold and Bitcoin really come into play. I think these are actually the two smartest asset classes in the whole world right now. They're seeing, look, we're getting too accommodative too quickly. Real yields are falling. This is like, you're going to blow the roof off these assets that are, inversely correlated to the dollar. So I'm long those two. I'm long stocks. I'm long oil. I'm not long bonds. I was long the 2-year bond, but now that the yield curve normalized, I sold out of that trade. And that's just kind of where I'm at right now.
Sure. Yeah. Yeah. Gold and Bitcoin, you mentioned it, and I would quickly want to talk to you about this as well, because I have two questions that I'm getting asked also quite often nowadays, is what is actually driving the gold price? Is it sort of like that gold is sniffing at the fact that there's money printing, or will be money printing quite soon, that we're entering this global easing cycle again? Or is it more geopolitical risk, as we just have seen today with Iran? And that's kind of the question. And the second question is then and Bitcoin, obviously Bitcoin is, as you said, the risk on play, so to say, or rather than the risk off play. But why is Bitcoin kind of lagging behind, for the last 2 or 3 weeks? It has caught up a little now with the geopolitical escalation or quasi-escalation. It has come down, but why is it still behind? Gold has already reached all-time high, but Bitcoin is not back to it,
So let's start with gold. All that money printing, we're talking about, and by the way, not just in the United States. I mean, look at France. France today informed the EU that they're not going to hit their 3% deficit to GDP target until 2030. So that's a 6-year delay. And if they're telling you that now, they're probably not going to do 2035, right? So money printing is one. The debasement of currencies is two, which is sort of 1A, 1B over there. 3 is falling real yields. If inflation stays at 3% and the Fed fund goes from 5 to 3, you went from a 2% real yield to a 0% real yield. So the best environment for gold is falling real yields, and we're cutting, and inflation is barely coming. Core inflation is pretty sticky, somewhere in like the high 2s, low 3s in the US. In Europe, it's not as sticky. So that's that. And then also there's the geopolitical thing. Again, not about right or wrong. I'm an American. I consider myself pro-American, politically and stuff. Russia invades Ukraine, and the US and Europe freeze Russia's dollar and euro reserve assets. What do you think she's going to do? What do you think Khamenei is going to do in Iran? What do you think Erdogan is going to do in Turkey? MBS in Saudi, you think she, before he, if something happens with Taiwan, he's going to leave their reserves in dollars and just have them froze? He can't put them there. He can't put them in euro. He can't put them in yen. He can't put them in pounds, right? Anything in the G7, he can't put them in those. He's not going to want to put it in yuan because he's going to raise the price of the yuan, and they're an export-focused economy, and that makes their exports more expensive, and that's not intelligent for an export economy to do. The only place they have left to put it is in gold, right? They need a non-volatile reserve currency that cannot be controlled by the West and will not raise the price of their exports. There's only gold for that. They can't own Bitcoin because it's just too volatile. They can only own gold. So yeah, I think we have these factors, and I've been talking about gold since December of 2022 at 1,800. Now it's 2,750 an ounce in dollars, and this is just, I think, the newest thesis that why would an adversary of the U.S. own U.S. reserves? I mean, would we leave our money in Chinese reserves? We wouldn't do that. That's crazy, right? So that's just that. And then as it relates to Bitcoin, look, Bitcoin's a risk-off asset. Bitcoin is very related to liquidity. I think Bitcoin's going to catch up. I'm long. I've been long Bitcoin since, I think, 33,000. I don't have a lot of it, but it's like 3, 4, 5% of my portfolio. It's not nothing. And I think Bitcoin catches up. The thing with Bitcoin, though, is its returns historically are very clustered. It's a flat line, and then it goes like that, and then it comes right back. It stays there. Then it makes another flat line. Then it goes up like this. So I think, look, Bitcoin had a very aggressive run in January until the end of April. So from the time the ETF launched until the end of April, it was up like 80-70% in the span of like 90 days. So I don't think I'm going to be so surprised if I look back on, the summer and the fall of 2024 and just say, okay, this was another one of those, lull periods that Bitcoin has between these big bursts. But look, prior to this risk-off event, Bitcoin was up to 65, 66K, and its all-time high was 72. So, and I think that was related to, the Fed easing cycle beginning. There's a lot of liquidity coming back into the market. Also, keep in mind that in terms of liquidity, there's about $2 trillion more in U.S. money market funds, which is basically just like buying 1 month treasury, 2 or 3 month treasury bills, than there was in 2021 and in 2022 before the rate hiking cycle began. All of that money, if we return rates to 3.5, is probably going to return back to deposits. And then commercial banks are going to lend out all that money, which is going to increase the money supply. When you increase the money supply, you've also increased liquidity. What is the most sensitive asset to liquidity in the whole world? It's Bitcoin. So that's one of the reasons that I'm pretty bullish on it. At some point in this cycle, it's going to happen. I just don't know when. I'll just stay long until it happens. And then maybe I'll trim a little bit of exposure. If it becomes 7, 8, 9% of my exposure, I'll trim it back down. But for now, I'm long, and I like the process, barring a recession, which again I don't see as so likely.
Yeah, great information again. Well, you said a couple of things, in terms of liquidity. I want to talk about this, but I also kind of want to bring in Japan and China real quick, because I think they're somewhat relevant to the picture, one could argue, So I think Japan, we have this new prime minister, which is about to enter office, and he was quoted saying that he wants the BOJ to be more expansive, again, as opposed to in the last few weeks, people were always kind of afraid, okay, Japan could be hiking and then, putting pressure on the dollar, and this as well, you get a stronger yen, which could then be kind of detrimental, for the system. And then you have China, which announced this crazy, I think it's the biggest or most aggressive stimulus package since COVID, so maybe, do you have any thoughts there?
I do. I have thoughts on everything, unfortunately. So in terms of Japan, right? So they have the new prime minister, who's a monetary policy dove, which is a little bit strange because in the U.S. and Switzerland, we don't really have political officials opine on monetary policy. We sort of separate them. Trump doesn't listen to that rule, which I disagree with. And also, it looks like the Prime Minister of Japan doesn't listen to that rule either. But that's very bullish risk, if you ask me. So if the BOJ is a little bit dovish relative to the expectations, the yen's going to fall. The yen falls means all those carry trades can be put back on. Remember, it was the yen getting stronger that caused that blow up on August 5th, 2024. It wasn't the yen getting weaker. So the yen getting weaker is probably a really good sign in terms of, Bitcoin, NASDAQ, any type of thing that was the Mexican peso, anything that was on the opposite side of that carry trade. And then the yen getting stronger is bad for all of those things. So I don't agree with what the prime minister did, but it's probably going to be good for my book. So maybe I shouldn't complain so much. And yeah, so then... But much more important is China, if you were to ask me. They've essentially announced $500 billion of fiscal stimulus, 2.5% of China's nominal GDP. And they've announced all sorts of things on the monetary side, lowering the reserve requirement ratio, lowering the one-year loan prime rate for banks, or maybe it was a 2-year. They, lowered mortgage rates. They made it easier to get a mortgage approved. They've laxed the home buying measures. So they've done a bazooka of fiscal and monetary stuff. If they stick with it, it's fantastic for Chinese risk assets. I mean, we've seen what's been going on in the past few days. My worry, and I'm neither short nor am I long China. I'm not short because, look, I don't want to get squeezed out of this position. You don't fight the Fed, you don't fight the PBOC, and you don't fight the CCP. But why I'm not long is China has committed to, since November of 2022, when there was the zero COVID riots, right after Thanksgiving in the United States in November 2022, China loosened up a lot of things and then has 3 or 4 separate times committed to some fiscal and monetary stimulus, committed to it, and never followed through. And then Chinese risk assets went right back into the toilet. China has a lot of problems right now, and if they're not going to take it seriously, no one is going to take all of this. This is China 2008 right now. People are not just going to, arbitrarily get long unless China is willing to help right now. And I think the China risks a boy who cried wolf situation where if they just keep saying they're going to do stimulus and then they don't do it, one time in the future, they're going to announce it and their stock market's not going to move. And then they're in a lot of trouble, right? Because then they're going to have to do more stimulus than they promise to show people they mean business. And because they're going to have to get paid, the investors are going to want to get paid for that, the counterparty premium that, they might not follow through. There's nothing you can do about it. There's no elections over there, right? There's no legal risk. There's no political risk. There's no risk to Xi and the CCP in the short term. There's risk in the long term, but there's no risks if they just don't do the stimulus that they promised. There's nothing anyone can do about it. So I'm just cautious because I've seen the story a few times. But if they go through with it, whoever has the cojones, as maybe I should say, to stick in there is going to make a lot of money if they're in China right now. A lot.
Mm-hmm. Yeah, exactly. I mean, it's a hot potato, but still, I mean, China, if as you said, if they were to kind of follow through with everything they kind of announced, this could kind of be crazy. But then, yeah, I mean, if we sum this up from a global perspective, we have the US, which sounds, as you kind of like neatly elaborated, it's still quite bullish. We have Japan, we have China, we have like all these like the entire confluence, So I was wondering, maybe my last question would be, it seems like we're entering this global easing cycle again, and the question is, how long will it take? And also maybe how is it different from the last easing cycle we had maybe in 2022 or in 2020 and 2021, where are like the similarities and where are the differences? Because I feel like you said something about money in money markets, which could be coming back. That's certainly something maybe which is different this time. It's also interesting and that's not sure how I interpret this. I mean, in the US, as you also neatly explained, the central bank is kind of trying to glide down an economy from being too hot and not really like trying to light it up again. So the question is, if there's now more stimulus on top of this, is this going to be bullish, or is it like, the economy is already doing well, so this is not going to, at the margin, do that much positive, So I'm really wondering, what is this easing cycle going to be like? Is it just like comparable to the ones we had in the past?
No, it's not comparable to 2020. 2020, we went from, we had a Fed funds rate of 0.5, if I recall, 0.5 to 0.7. I think on March 1st, 2020, the effective Fed funds was 0.66, 0.67 or something like that. It was zero by March 12th or March 15th of 2020. So all the monetary stimulus that was possible was done in 2 weeks. And that was the reason we had to rely on so much fiscal stimulus, because there was no other lever for monetary to pull. One of my problems with the president of any country opining on on monetary policy is the Fed in 2017 and 2018 had hiked the Fed funds to 2.5, right? Mm-hmm. And the logic of that was at the time we were in year 9 of an expansion. And at some point, this economy is going to cool off. And we would rather not have to do a fiscal bazooka, because that entails taking on debt and there's very quick inflation risks there. We would rather do it as a monetary stimulus program. Trump says, no, you got to cut. He probably just wanted to get elected. I don't know what else he would care about. And he gets his way, and we cut. Through all of 2019, the economy was roaring hot. I remember it clearly. The economy was roaring hot. The NASDAQ was up 40% that year, and we were cutting. I don't know what we were cutting. We cut 200 basis points in that vicinity in maybe 24 months' time. And what ends up happening? COVID comes down. We get a real problem. We have no monetary policy, ammunition left, and we end up relying on fiscal. That goes crazy. He loses the election. A new administration comes in. Again, rates are at 0. The new administration, Biden also wants to look good. So he comes in with his own fiscal package, and all of a sudden we've grown the money supply 50% in a span of, 18 months. We did something. Listen, obviously COVID was very bad, and it warranted some of that. It probably didn't warrant all of that, and we're still dealing with the ramifications of that, and we'll probably be dealing with ramifications. I mean, look at today, the dock workers union in the United States. 50% of the cargo in the U.S. gets imported through these docks. They're asking for a 60% raise, right? That inflation, that this problem's not over because, okay, now price growth is 3% versus last year, right? People haven't gotten raises since 2019 and the prices are up 35, 40%. We're going to be dealing with what happened during COVID for 10 years. Just like we were dealing with what happened in 2008 for 10 years. So, again, that's just a little bit of a rant on why I wish presidents wouldn't opine on monetary policy, because their incentives are just to get elected, and monetary policy's incentive is to actually help the economy when it needs it. And when it needs it, doesn't always align with the political calendar, right? So, that's that. And in terms of how much it's going to help, it's not going to help immediately as much because of the fact that, so many households have an effective mortgage rate of below 3.5% in the United States, right? They either have no mortgage at all or they have a 3.5%. And unlike, let's say, Sweden or Canada or Australia, where there's basically variable rate mortgages, which means if the central bank changes the mortgage rate, the overnight interest rate, your personal mortgage rate changes immediately also. We have no such thing in the US. So I know I have many friends that they are paying a 2.8% mortgage. They couldn't care less. The Fed funds can go to 30%, it wouldn't affect them, right? With that being said, though, as the Fed funds comes down, there's a lot of small cap companies that are borrowing based on Fed funds or based on SOFR plus a spread. There's a lot of short-term debt that's based on SOFR plus a spread. There's a good amount of people that, got 8% mortgages. They're going to get, some easing. So yes, it is going to help. There's no way it's going to hurt. But it's not going to help as much as maybe it would have in a more traditional cycle. And then on top of it, we have all that fiscal, and fiscal is very price insensitive. The government doesn't care less. They just spend money. It doesn't matter to them what the interest rates are. So yeah, I mean, monetary policy will help. I don't think it's my number one book. I think my number one book case is this continuation of the fiscal, and that's kind of where I'm at.
Cool. Yeah, great thoughts. I mean, Spencer, I think I want that you can head off because you said something about you want to go before markets close in the US. So thanks a lot for all your interesting thoughts. Maybe I have just one little last question is there any guests that you could recommend that we should bring on that you think is just somebody we need to talk to? Anybody springs to mind?
Of course. Yeah, there's a gentleman named Danny Dayan. He's based in Montreal, Canada. And there's another gentleman named Eric Wallerstein. He's based on the West Coast of the United States. They're very smart people. Their accounts are really underfollowed, if you ask me. They are really smart, sharp guys. Eric used to work at the New York Federal Reserve, then at the Wall Street Journal. Now he's working at Yardeni Research. And Danny was in the hedge fund business. I believe now he manages his own money. And I think these guys are worth talking to.
Cool, nice. Never heard of them, so surely you have to, show me to them. That would be nice.
Sure.
Yeah. Thanks a lot for your time, and I hope you enjoy the rest of your day. And thanks for everything.
Thank you so much. Have a good one.
You too. Bye, Spencer. Thanks.
Thank you.